Good morning from Chicago. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, February 2nd, 2025. Asbury Research is a registered investment advisor and has been providing both investment research and asset management to individuals and professional money managers since 2005. We are now also providing access to our Asbury Research models and model portfolios to other RIAs as a third-party money manager. You can learn more about our 4 model portfolios right here. Go to asburyresearch.com and you can click Asset Management right here up at the top. In today's podcast, we are going to be taking an updated look at 2 of our models, the Asbury 6 and the CEF model, the latter which is our sector rotation model. We're also going to give you a look at some key charts through our most recent Keys to This Week report that we think will be particularly important to pay attention to over the next week, especially with the news that came out very late on Friday that the U.S. is going to be putting 25% tariffs on both Mexico and Canada and 10% tariff on China. Those 3 countries are our 3 largest trading partners, and combined, they account for about 50% of our foreign trade. So let's begin by looking at what the internal condition of the market is via our Asbury 6. Our Asbury 6 is a daily data-driven gauge of the U.S. stock market's real internal health, according to 6 diverse individual metrics, which we selected via quantitative backtesting. Basically, what we did here is as it became progressively more and more difficult to determine what the S&P or what the health of the stock market is by looking at the S&P 500 and maybe some standard technical indicators like relative strength and stochastics and indicators like that, the volatility of the market, you've seen those days where we're up, the S&P is up 70 points on Monday, down 50 on Tuesday, and up 50 on Wednesday. We just had that over the past week. This day-to-day volatility is really easy to get pushed out of a good idea. So we wanted to build a metric that avoided the noise and looked at the health of the market. Kind of like when you go into the doctor's office and he gives you your annual physical, and the first thing he does is he performs those 6 tests. He checks your blood pressure, he checks your pulse, he listens to your heart and lungs, checks your reflexes, just to get a baseline of what your health is, which may be different than how you look when you were walking into the office for your checkup. That's what this does for the market. We have 6 different metrics here. We've got the rate of change in the S&P 500. We have relative performance, asset flows, volatility, trading volume, and market breadth. Right now, they're all green. Positive. 4 or more of these metrics have to be green for the status of the model itself to be positive. 4 or more red would turn the status of the model to negative. So right now, everything's positive. All these dates, all these numbers in here, these are the dates that the individual metrics turn positive. So even though we had a rough day, or a rough hour, I should say, at the end of the trading session on Friday, everything is still green heading into next week. However, looking at these individually through our own charts here in the office, I can tell you there's several of these that could very quickly turn to negative. They could very quickly turn red if the market doesn't come out of the gate strong in Monday, Tuesday of next week. So this is a big indicator for us. This is letting us know now that the market's had a couple of days on the weekend to try to digest what happened late in the day on Friday. This is going to give us a big idea of, or a very good internal idea of where we go from here. The next one we're going to take a look at is our CEF model. Our CEF model is our sector rotation model. I built the first version of this with my son, Jack, about 7-8 years ago. Sector rotation was starting to speed up, and just watching the relative performance charts weren't giving us much of an edge. So I started to test different ways to measure the velocity of money as it moves around the 11 sector spiders, which together are the S&P 500, because asset flows typically lead price movement. So we developed a quantitative methodology that measures the velocity of money as it's moving around those 11 sector spiders, and we came up with a ranking system in 3 different time frames: trading, tactical, and strategic. The fastest money moving in for that particular time period has a ranking of 1. The fastest money moving out in any time period has a ranking of 11. So last week, over the past 5 days of last week, fastest money that was moving in was in financials. You can see it here. Fastest money that was moving out of any sector was out of technology. And then we add those scores across the 3 different time periods, and the lowest scores are the best. So heading into next week, the 3 highest ranked scores are financials, XLF, communication services, XLC, and consumer discretionary right here at XLY at rankings of 3, 10, and 11. So let's move on to one of the reports that we produce for the premium research, which is what you're looking at every week, to get a sense of where more classical technical analysis is showing us maybe what we can expect next week. The first is the support and resistance levels in the S&P 500. This is a daily chart. This goes back to May of last year, and this is a 2-day-old report. Our premium subscribers got this on Wednesday morning. It's Sunday afternoon right now, and Friday's data is not here. But what happened Friday is we came up and tested this all-time high that we made on January the 24th. Then the news came out about the tariffs, and the market kind of slammed the other way, and it actually closed a little bit below this support level at 60.50. The next support level, and the most important one for me next week, is the 50-day moving average, which is a minor trend proxy. It's currently at 59.84. If we break through there, for more than just a few hours, if we start to trade through there, it's going to suggest that we are beginning a corrective decline. Caveat with this next corrective decline, whenever it's going to be, this market's very overextended. The S&P has risen by 75% since October of 2022. It's risen by 48% since October of 2023. Here's the October 2023 trend line here. What does that mean? It means the next time we have a correction, the likelihood that it's going to be larger and nastier than your normal correction, in our view, is pretty good. The market's a mean reversion animal. It tends to come back to the mean. So the reason I'm bringing this out is most of our premium subscribers, most of the people that we are managing money for are older investors. They're wealthy, they're more risk averse, and to me, when you're 30 or 35 years old, buy and hold is okay because you're building a base for later on in life. Once you get into your 60s and you're kind of like a football team that's got a lead that's going into the fourth quarter. I'm in my 60s as well. I see this as the fourth quarter of our investment game. Let's call it that. So if you take a big hit in the fourth quarter, you don't want to fumble the ball in the fourth quarter. You don't want to be throwing Hail Mary passes. You want to try to play the game but with less risk. How do we do that? When the Asbury 6 tells us that the market is weakening internally, or our CPM model, the correction protection model, which is also here. And by the way, if you go into research here and want to learn more about our models, that's how you do that. But again, risky situation here. You don't want to be taking a 30% drawdown when you're in your 60s or 70s. Our models will help you not to do that. If our Asbury 6 starts to turn to red next week, it'll be an indication that we need to start to protect ourselves. If our CPM model turns to risk off, that's actionable. That's time for us to try to protect ourselves on the downside. So let's look at a couple more charts here. This is the NDX. This is a NASDAQ 100. That's the big cap index with all the big AI names in it. It's doing fine in terms of the price chart. You can see it's above the 200-day moving average, and it's above its high from July of last year. This is fine. The relative performance versus the S&P is a little concerning to me. Note that it's been underperforming since December, and this is versus the S&P. So this blue line, I should explain, is the daily relative performance of NDX versus SPY. It's testing its 63-day moving average. That's our strategic time period. If it starts underperforming, and it's starting to do that now, if it starts to consistently underperform the S&P, which means this blue line is underneath the 63-day moving average, which is the green line, like we had back here, July of last year, that gave us all of this move down in the NDX itself. So I'm really concerned about this particular chart. The other one I'm concerned about is the SOX index, the semiconductors. Semiconductors and technology usually lead in a healthy bull market. What's happening here since the end of last month is that the SOX is now underperforming SPY. If that keeps up, more indication that one of the market leaders is now underperforming, and that makes the broad market, the S&P 500, more vulnerable to a decline. Let's look at one more. This is NVIDIA. NVIDIA, I don't know if it's still the very tippy top in terms of market cap. It's been one or two all year, mostly one with the largest market cap. It's been trying to stay above its June 20th of last year high since October. Hasn't been able to do it. Meantime, look what's happening relative to the S&P 500 down here. This is the blue line. It is now underperforming the S&P since January the 24th. That's another problem for me. So again, these are things that you're not going to see when you're looking at the S&P 500, but things that we are concerned about and we think you should be too. One last thing is we have a smaller service. It's a Substack newsletter, and we just added a feature to it, so I wanted to make you aware of it. It's called the SORT Report. SORT is an acronym. It stands for Strategic Opportunity Radar Tracker, SORT. And what it does is it uses 3 internal metrics that we use here to try to determine where opportunity is that have to do with trend and relative performance and money flows. And then we look at 10 global places to invest, asset classes, everything from crypto to gold to crude oil to the US dollar to foreign equity markets. I think there's 10 of them here, and then we rank them according to those 3 criteria: trend, money flows, and relative performance. Right now, there are only 2 that are green all the way across: crypto and gold. That means that's where the opportunity is. This is updated on our Substack service, which is $25 a month, by the way. This is kind of an entry-level version of our work here at Asbury Research that does not give you any of the models that you get with the premium service, but you do have a lot of charts, a lot of research, and the SORT report, which is going to give you 32,000-foot look at where the opportunities are throughout the globe. So check it out, asburyresearch.substack.com. There's also a free version if you'd like to give this a trial run. Finally, one last thing. Thank you to those who sponsored my son Jack and I when we participated in the Saturday, January 25th Polar Plunge with the Chicago Polar Bear Club to help raise money for 4 Chicago families who were in pretty desperate need of some help. Together, I think the club raised about $90,000. This was Jack and my second year participating for Asbury Research, and we will be back to freeze our our rear ends off again next January to do it all again. Also, thank you to the 7,000 plus investors that signed up for my 11th annual January Investing with Asbury Research webinar for Fidelity Investments. In this hour-long webinar, we went through all the Asbury Research models and model portfolios. You can request a copy of the PDF slide deck from this by going to asburyresearch.com and clicking the Contact Us button right here up at the top and typing Fidelity slide deck in the little text box down at the bottom. So there you go. That wraps up another Asbury Research Following the Money podcast for this week. Our next Following the Money podcast is going to be tentatively scheduled for Sunday, February the 16th. For questions or more info about us or the model portfolios we talked about today, you can contact us right here through the website. And don't forget to like and subscribe. We'll see you in about 2 weeks. Have a great Sunday.